Welcome to the Algorithmic Advantage. We're here to expand the toolkit of the quant trading community and introduce investors to the many advantages of systematic trading. Our goal is to educate and inspire as we embark on a captivating journey into the vast knowledge and experience of leading portfolio managers and other experts in the field. We hope you enjoy the show, and if you do, please subscribe, leave us a review, or even buy us a coffee via the link on the algorithmicadvantage.com. We really appreciate it.
Welcome everyone to the Algorithmic Advantage. We're recording on the 24th of October 2023, and it's our great pleasure to have Linus Nilsson with us in the studio today. Before I say hi to him, of course, I'll welcome my co-host, Rich Brennan. Rich, how you going?
Very good, Simon. And how are you, Linus?
I'm really good. It's my pleasure to be here. Thanks for having me.
Welcome, Linus. Welcome to the show. Thanks so much for coming along. Let's just kick off with a bit of a background, if we could, so that we can get an idea of where you've come from. We know that you run this database and we want to get into that today. That's going to be a key part of the show, but give us your background in trading and in the markets. We know you've worked with Art, who we had on the show recently at Man AHL. So run us through your history and what led up to you creating the database today.
So I think I entered sort of the futures markets in 2001 when I started work for a Swedish fund of fund. We were a CTA specialist. We were doing a lot of global macro managers. It was a pretty good time to be a CTA trader in 01, sort of on the back end of sort of the first Nasdaq crisis. So that was sort of I think that sort of it bit me. So I've always more or less the 10-15 years, first 10-15 years of my career, I was allocating to managers. I was mostly CTAs and hedge funds, with a clear emphasis on the systematic managers. Then in 2012, I thought I could do it myself. So I owned a seeding firm. Had built my short-term strategies. I have had the most wonderful short-term CTA. I quickly found out that building systems wasn't the hard part when it came to building a business. It was raising the assets from clients. And eventually in 2013, I sort of left that seeding firm because I couldn't sort of come through with their seeding capital. I went to a French CTA and ran that CTA for a couple of years. It was more of a classical trend following CTA. We had like 2/3 of the risk was allocated to trend following strategies in sort of mid to long term frequencies. And then that didn't work out. We couldn't even disagree to agree, or agree to disagree. That's a proper. So I went to join a Dutch bank, and then eventually I ended up working for a Dutch pension fund. And in 2018, I launched the database as a way for me to sort of keep track of all the managers out there in a systematic manner. And we all know what happened in 2020. COVID happened, so it became my COVID project. And during that time, it actually sort of grew and grew. And last year, I sort of took the decision to sort of fully commercialize the database. It's a slow grower, but it's a steady growth. So, questions on that? So that's my short introduction. So,
tell us a bit more about how you got to know Art.
Oh yeah, I forgot about that. I worked for Man in between 2006 and 2012. And I met Art when he entered the floor in our sort of Manhattan office, where I was living and working from 2008 to 2012. So he was running the portfolio construction for the fund of fund back then, and I was sort of I was running part of the CTA exposure that we had. So I was overseeing our North American managers, and we had quite a few of. We knew at least one of the managers you have interviewed so far, probably a few of the turtles as well. We actually had money with one of the turtles that shut down a few years ago. I think he was sort of the Paul Raybar. He was a second most successful turtle compared to Jerry Parker.
So with all of that history and allocating and looking at so many other funds, you decided to put together your own database that compiled the track records of every fund you could find. So tell us about that. And I know very little about it. So what's the basic introduction to, what is in this database and what are you trying to achieve with it?
In the beginning, it was sort of more of an information source for myself. I had a mandate to allocate to commodity managers, a mix of very sort of systematic and discretionary commodity managers. I couldn't find a database that had that data set in a good format for me. And that was the origin of the database. My mandate changed, and then I actually sort of already had all of the code, the data structure and everything, and then sort of it expanded into... The first step was to expand into CTAs, trend followers. I know that you're pretty familiar with that term. I heard that Rich likes his outliers.
He does. He mentions those
Yes.
from time to time.
Yeah. the skew. It's beautiful when you experience it, but it can be pretty painful the time in between. And now sort of the database sort of covers pretty much all liquid strategies. So I cover the gamut from CTAs to long short equity to event driven, and actually have sort of a fair amount of crypto managers in there as well. It's probably less crypto managers than 1.5 years ago, but that's part of the evolution of any sort of emerging manager space. So.
At last count, Linus, I think there was over 4,700 programs in there. Is that grown now? What's its current level?
I think in terms of sort of active funds, it's probably closer to, say, between 2,000 and 2,500. And then there's of course a graveyard. People that failed, and I think could it be 6,000 funds or something?
Okay.
Wow. That's an important question. So you do keep a track of the failed funds. So you're including survivorship bias in your data set, if you like, so we can see who went and when they went, which is interesting.
Mm-hmm.
And so do you categorise all of those funds into, particularly, of course, we're interested in whether you categorise them into systematic, discretionary. What other categorisations do you use?
So there's various types of ways of categorizing hedge funds, and there's not one way, and it's sort of very subjective. One way is, of course, you can categorize them sort of systematic versus discretionary. That's at the edges it's relatively easy, but then it always becomes like blurred in the middle.
Yes.
I know we have the two Moritzes. They're mostly systematic, but then they run their sort of option overlay, which makes it sort of more discretionary. So that's always like the nightmare you have as an allocator when you want to look at those strategies. So then, of course, it's sort of by sort of which main. So I have CTAs, I have equity long short, crypto, event driven, market neutral, etc. And then there's also usually like a sub strategy for each manager. So in the CTA space, I probably have 10 different classifications of managers. Trend following is, of course, the biggest category in there, and I think closely followed by multi-strategy managers.
And as you've got also categories such as fundamental. There's a whole range of them, aren't there?
Mm.
Which sort of does give a degree of drilling down. You can drill down to a degree.
No, I hope so. It's probably mirrors the way I thought about managers. It probably don't mirrors anyone else's way of thinking about managers, but it was useful for me when I was trying to build indices, sort of try to benchmark the things I was doing.
Now, of course, one of the things we're really interested in, given that this show is all about educating traders and helping traders become better, is helping traders benchmark themselves, and I think that retail traders will be interested in knowing what everyone else is doing, what they're achieving, how well they're doing in different periods. How do we benchmark ourselves? What statistics do we use? So if we were to talk about that side of things, have you, just at a high level first, have you got any insights into, I guess, what works, what doesn't work, who's been around the longest? What have you found in the data personally that's of interest to you?
I think this is probably going to sort of give you some joy, because it's mostly the trend followers that's been around for the longest time. You have, I think, the current. I'm not sure if it's Dunn or Campbell that has been around for the longest time, but they certainly have sort of business that dates back to the 70s.
Yeah, I think Dunn goes back to 74, doesn't it? I think.
Could be. And I think Campbell is probably like 80-ish, 84-ish. And of course, they have, it's not the same managers as it once was, so they've probably changed quite a few times, but they are predominantly sort of trend following in nature. Then, of course, you see some of the sort of other exceptions. You have some short-term traders that have actually stayed around for quite some time.
On that track record, Linus, is it because it was only trend following to start with, or is it because of the nature of the strategy itself, its ability to survive, that we have this long track record? What's your feeling there?
I suspect it's much relates to the personality of the traders actually that are running those, because it's this. I usually like to say that trend following is a pain arbitrage. You take a lot of pain, and then eventually you have some sort of episodic gains. You have like pretty lumpy return streams where sort of you suffer for a long period, and then you have like a few months where you're the king of the world and everything is really nice. And then everything works out. But you have to survive during the drawdown, and those drawdowns for trend following strategies can be pretty chunky and pretty long. Of course, that's when you have like in this current environment, when the risk-free rate is close to 5%. That's going to reduce your drawdowns. I know. I'm not sure what the short-term Australian rate is at the moment, but for everyone that's denominated in USD, that's going to sort of help to lift the performance quite a bit, even if you can't find any positive trends.
Yes, yeah. Well, about 80% of the 80% of the funds of trend followers tends to be in cash, with 20% being actively traded. So, with this interest rate environment the way it is, it's certainly going to be a windfall for trend followers. That sort of is how I saw it back in the 80s up to the 2000s. There was a significant addition to trend following performance by virtue of the overall interest rates. But I think we're back in that environment.
Great bonus.
Yeah.
So, Linus, if you can track so many trend following strategies all at once then, and you're talking about this pain arbitrage, so trend following, if you like, works because there's an opportunity in the markets to profit out of being one who's willing to take that pain. But looking across various managers, how correlated are they, and do you see the opportunity to then allocate to a spread of managers, and how much benefit does that give you in smoothing the returns?
I would probably put it this way: you're probably not going to smooth your returns that much, but you're going to avoid the big mistakes, because there's always a trader that's going to miss, that's not going to have an allocation to that particular market that has like a crazy trend at the moment. I mean, we have orange juice or say sugar that is trending pretty well. Not all managers, or to be honest, very few managers is going to have allocation to orange juice, because it's one of those markets that is, pardon the pun, it's not very liquid, it's frozen. So,
understood. So I'm also very curious to ask about this so-called lost decade for trend followers. Now, for a small trader like myself, like, it's inconceivable to have a lost decade. So are there any traders who survived that, any managers who did better than others? Are there any indications as to what they might have done differently? Were there any solutions to that problem? What have you learnt about this?
So I think the ones that survived the best. I mean, if you look at sort of the say the top 10 managers by AUM, you're going to find it's pretty much the same managers that were around in 2012, maybe with a few exceptions. There's some managers that fell out of the ranking, but you're going to see that the big ones got bigger. They probably launched more program that wasn't sort of core trend followers. They launched a number of say alternative market CTAs was really in vogue a few years ago because it offered sort of access to China, it offered access to sort of markets that were slightly more difficult to trade. And I think there was just at that point in time there were better trends in those markets. There were sort of probably less competition. Which is one of the problems sometimes when you see those kind of correlated exits and all CTAs are in the same position and they're trying to get out of the same trade. You had that happen in March this year when the fixed income market reversed. It looks like the guys that were sort of longer term in nature, they're still stuck to that trade, and that's probably drives a little bit of their performance when they came back pretty rapidly. And you have a multiple number of those sort of correlated exits, and it's all the same strategy. And maybe it's of course you can't say that sort of it's just the trend following that affects the market, but they're certainly experiencing pain in those. So I think that give raise to sort of all of the alternative market CTAs you saw, and sort of people adding that. You probably saw people sort of gradually shifting from being trend followers to becoming multi-strategists. You had a number of the big managers just going into the COVID crisis. People were sort of ditching trend following, so we're never going to touch this again. Mm-hmm. And that's usually when the strategy sort of comes back with the vengeance. Those managers that made that mistake, they went into pretty severe drawdowns. Most of them have come back, of course, but I think their clients punished them pretty severely. So there's sort of a lot of the assets left those firms.
Hmm. Do you track some of the non-trend followers, and are there any of those that have performed well for a reasonable amount of time?
You have, since you're Australian, you probably know sort of the two big. You had two big short-term traders in Australia, Boronia and Kaiser. One of them is sort of-ish around. I'm not sure if Boronia closed a long time ago, and I think Kaiser is they're around, but I think it might be a different strategy. There are some other short-term traders that have done really well and have excellent long-term track records. Crable is probably one of the traders with sort of the longest short-term track record that I've seen out there.
Interesting, Simon, when you talk about the lost decade, I don't really like that term, because if I look at Linus's data over 30 years of trend following performance, I see these distinct, what I call regimes. So the period up until 2008, 2009, from about 2000, the overall CTA performance I found in trend following was a steady progression. There wasn't any sort of protracted periods of stagnation. It was fairly steady growth through that period. But then post GFC, we got a different regime with quantitative easing, I assume. But we had 2-3 years of stagnation or building drawdowns, and then we had a big explosion in 2014 in performance returns, and then from 2014 up to 2020, once again we entered this period of sort of stagnation, building drawdowns, and then from 2020 up to 2023 was the blossoming again, once again, of fairly steady growth across trend following for the last 3 years. So when I view it that way, I see it as altering regimes. I actually don't see it as a lost decade, because I think 2014 was a major contributor for many trend followers, but there were certainly periods of maybe 3 years, then a big explosion, then periods of 4 years, which was sort of, to me, indicative of a changing regime where, let's assume there was quantitative easing. Central banks were flooding the market to basically stabilise volatility, and with all of this money being injected in the markets to stabilise it by selling the tips and buying the dips, it entered a sort of a mean reverting regime over that period of time. But there were certain points in time where the rubber bands broke and we got this explosion of trend. That's the way I see it. So when I actually see the period 2010 to 2020 in terms of the long-term track record as the anomaly. I don't see that as the rule. I see that as the exception. How do you feel about that, Linus?
I think that's a positive take on it. I think you probably have to be you have to expect, like, you're going to see one other those sort of trendless periods where the bulk of the market doesn't trend, right? You might have one segment of the market that is trending nicely. Like between 2013 and say 2018, there was most likely equity markets that did pretty well. Bond markets didn't sort of exhibit anything. It wasn't anything exciting volatility in there, and commodities was pretty much dead from a trend perspective. There was no allocation flows into it, which is sort of what sort of, if you look sort of if you're speaking about regimes in the sort of 08, 09 regimes, you basically had flows into all kinds of you had flows into hedge funds, you had flows into all kind of index funds, the boom, the growth of the ETF business. So you had a lot of flows into, you probably remember sort of the finalization discussion that you had about commodities in 08 to 09, and where basically big institutions just came in, like basically on a not-for-profit reason into commodities. They just wanted the exposure to provide some kind of diversification. That of course created a sort of the perverse effect that the more institutions were into those, the more correlated they got to equities. And you saw that flip side sort of post the 09, where everything sort of started behaving like equities. So I think from the performance expectations view, you shouldn't not expect another lost decade, but maybe you should see like 3 years of non-performing, which is pretty normal in the CTA space. It's just about sort of surviving the drawdowns and making sure you can stay with the trade.
So you're saying when we get these periods of 3 to 4 years of stagnation, we keep calm and keep trend following? Is that what you're saying?
Yeah. What's his name? Ed Sikota. He has this beautiful. He has a whipsaw song. I'm pretty sure you have seen it. But yes. You should play that every time you have a tough time in CTX.
I do.
Yeah.
I haven't heard that one.
Oh, yeah.
You've got to hear the banjo song, Simon. It's it keeps the trend follower going during tough times. Yeah. During the pain arbitrage, you put on the banjo song and you're set.
Yeah.
So Linus, how do you create this database? Like, how does it work? And how do you collect the data? And how does it differ from, say, an IASG or an RCM database?
So I think the main difference there is that I'm not an introducing broker, so I don't try to push CTAs or managers to my clients. That's so I don't have the incentives to dress up the managers in a particular way. I think some of those databases they have a tendency to quickly forget about the traders that failed. It's just in the nature. You can't sell a manager that is in a 2 or 3 sigma drawdown. You probably don't want your clients to focus on it. But I think those products are really excellent because they have a clean interface towards the clients, which I don't have in this stage. Being true to my Swedish roots, I have sort of the IKEA solution. You get sort of the pieces, and it's up to you to put that together into your own spreadsheets. I know Rich has done that in an absolutely beautiful way, and that's sort of the skill set you need to have.
How do you do that, Rich? How hard is it?
I'm a big fan of Linus's database because I love working with data, and And what I do like about Linus's database is it's research driven. So there isn't, as Linus was saying, there isn't the branding surrounding it. It's an ideal resource for someone like me who's looking for good quality research in terms of the monthly performance returns of a vast array of fund managers. But what I do, my particular performance report I generate each month is only looking at those trend following programs. So for a start, because I'm working with trend following programs, I've got to use a lot of filters because Linus's programs are very large, extending over thousands of different types of programs. So I'm using filters which Linus uses to restrict that to globally diversified, systematic trend followers. And then on top of that, I add an additional filter, which is looking at those with a long-term track record. So I'm looking at the performance, basically, of the long-term success stories of trend followers on the basis that, to me, when there are lots of different risk measures we can apply to assess the performance of different managers, but to me, the ultimate measure to use is actually the track record itself, because that tells you how a manager has been able to survive the different regimes, and it tells the particular caliber and the particular quality of the manager that's not necessarily measured by a Sharpe Ratio or things like that. So when I'm using Linus's data, I'm looking for the long-term database, and then so I extract Linus's data. So I download from his website, and that produces these CSV output files, which then go into an Access database for me. So then I have all of the data, and then I do the filtering, and then I extract that into a spreadsheet output to develop my my monthly reports, which develops the charting and those sort of things. So that's how I use it. It's invaluable to me. I have alternatively previously used other sources such as IASG and those sources, but there wasn't the ability to really quickly extract data, quickly put it into the format you require for your analysis. So if you are familiar with manipulating data yourself, I find Linus's tool Linus's database is ideal for what I'm looking for. So that's how
talking
I generate.
about reviewing funds and benchmarking our performance, and especially for the newer trader or newer manager, Linus, what do you like looking at in terms of metrics, and even speak a little bit to the, the compound annual returns that are expected? Because I'm thinking of the newer traders who always begin this journey with very high expectations, and they generally need to be cut down quite a bit. So comparing ourselves to the best of the best is the most logical thing to do. So how do they compare, and what kind of metrics do you like to use, and maybe could others use to assess their back tests or their performance?
No, being an emerging manager, that's an incredibly painful journey. It requires probably requires sort of it requires more capital, more stamina, and more sort of just pure grit to work that through. Because it's probably going to take you 3 years before you get any sort of serious type of allocations. That's a sad story. You might find some people that are willing to give you sort of based on some kind of proprietary tracker you traded with your own money, but that's it's probably the sort of the high net worths that can give you that kind of tickets. They take a bet on you and see if it works. They get some sort of excitement for that. It's a little bit like buying a lottery ticket. You may actually be the next Jim Simons. That could.
Do you have his funds in your database? Do you have the Rentec funds?
That's sadly not. I know. I've seen the tracker a couple of times, but it's usually been flashed in front of you, like to see to get the attention away from their other funds that are not as good as the medallion fund. So
yes. Okay, so what about metrics? Do you like just using the Sharpe, and what would you recommend others could look at? I mean, Rich has just mentioned the track record itself, which makes sense as well. How long have we been around, and how has it performed over time? Obviously, is critical.
Yeah, that you won't have the long-term track record as an emerging manager. That's part of the problem. But in those cases, like, okay, you need to have at worst you probably have a back test. No one is going to trust your back test. That's how it is. But you need to have you need to show your client that you have realistic expectations. If you have come up with a trend following strategy that has a Sharpe of 3 in backtest, you should probably tell your client that they should not expect that. They should expect sort of a Sharpe of somewhere between 0.5 and 1.
And that's where benchmarking comes in, Simon, because when you benchmark against industry, you see that there is this stable Sharpe ratio for the different types of program.
Yeah. And it's kind of amazing because there are quite a lot of managers that built really big businesses on strategies that have Sharpe ratios below 1 and 0.7-ish. That's been enough to sort of build a multi-billion-dollar businesses.
Incredible, isn't it? And so what kind of other metrics do you look at? What kind of returns do these guys make?
I think the beauty of CTAs is you can basically you can scale your returns. Once you've set your volatility target, you can scale up and down the returns. You probably know that if you put your expectations, you get sort of half a unit return for each unit of risk. Then you can sort of try to build the portfolio with those assumptions, and then you probably need some diversification, but you can probably also lever up your CTAs quite a bit, so to allow them to be more capital efficient. So I never look I don't have like a set ratio. It's much more important how it actually fits into with other managers. From a fund of fund perspective, you're always looking for the decorrelated managers. Which, given sort of its coming out of the CTA business as an allocator, that was sort of the curse, because every diversifying manager you found out there, eventually they didn't really work as well as they did before you allocated to them. In the end, the trend following strategies was a strategy that prevailed the longest, and it's still prevailing.
When you talk about non-correlated managers, is that a quantitative decision only, or is there some subjectivity there in that you can apply some discretion to what kind of strategies they're trading, and you feel from your experience that they're going to be non-correlated going forward?
I think the narrative you tell as a trader is very important, because it's going to set the expectations right with the clients. It's going to help the client understand what's actually happening, and it's probably that understanding is crucial when you have when you're having a rough time. If you're trading mean reversion, or if you try to come across as a trend follower with a trend bias, and you suddenly start doing 90% of your portfolio, it becomes sort of a mean reversion trade. Then your clients will not understand your drawdowns, and then they're gonna sort of abandon you pretty quickly. That's just the nature of the game. People tend to have. It's basically what have you done for me lately bias. That's a little bit sad, but that's the harsh nature of it. And I think you see that in a few of the the CTAs that sort of raised quite a bit of money lately. They raised money on the back of sort of the last year's performance, and now this year sort of assets are coming out not rapidly, but they are dripping out. It's a steady outflow rather than a steady inflow.
Linus, can you tell us a bit about, let's say you want to use your database to develop a fund of funds, or at least conduct research to evaluate the different programs you'd put together for a fund of funds. Could you tell me how you'd go about it using your database and using your knowledge of allocation?
So, of course, I have a number of analytical tools inside my database engine. So I can run probably similar tests to what you're doing in your Access database. So I could screen a particular manager for, are they correlated to the manager I'm already have in my portfolio, and preferably if I make an addition, I probably would like to have a manager that is not very highly correlated. If I'm making a replacement decision, I would probably actually like a manager that is highly correlated and sort of doing something similar in the portfolio, but I would like to sort of increase the quality.
Are these decisions systematic or discretionary at this point? What we're discussing here?
I think in the end it's going to be a screening based approach, but in the end it's always discretionary. I've yet to come across a fund that's doing it sort of purely systematically. There's always going to be some discretionary hurdles. Sort of, is the manager actually fit for purpose? Is it the right character? Can I trust the guy on the other side of the table? So that's extremely important. If in the end you're giving either your own money or your client's money to a manager that is outside of your control, and there's definitely a trust hurdle there. So. And trust me, bro, it ain't gonna cut it. So.
Shame that. So Rich, when you use Linus's database each month, what are you picking up anything in terms of like how do you like to assess their performance in terms of the traditional ratios? Does Sharpe mean something? Do you like the Serenity ratio? Do you look at their max drawdowns? Are you looking at their annual return? What other things pique your interest?
I deeply got involved with the Serenity ratio, as Linus knows, because we were tic-tacking via emails trying to work out the damn thing, and it's a horrible set of calculations. It really is. But look, I've over the course of time, I've sort of gone back to the simple one for me, and this is because I'm purely looking at trend following. So because I'm looking at trend following, I like a path-dependent metric. So in other words, something that's looking at the maximum excursions, both positive and negative. So I'll come back to probably a simple ratio like the MAR ratio as the ratio I'm trying to optimize for when I'm bringing together trend following programs. But if I was in the world of mean reversion, your universe, Simon, I'd probably be using Sharpe there, because Sharpe to me is a better measure in the land of mean reversion than in trend following, where we've got positive skew, we've got the characteristics of the returns are lumpy. In that instance, I'm not looking at Sharpe as a measure, because I prefer to see effectively how, when I blend all of these different trend followers together, I'm trying to get outliers in all of those trend followers at different degrees along the time span. So I'm not trying to sort of cluster my outliers in all one area. So if I'm bringing together 10 or 20 trend followers, I don't want to see that all of their performance is attributed to 2008, 2009, and then 2023. I want to see this performance distributed as distribute my outliers across the time series, so I get the benefit of compounding across the time series without getting this volatility drag that accompanies these high volatility models. So I actually do use a systematic process in trend following world, because what I do is I'm taking Linus's data and I'm firstly filtering out common characteristics to try and get a bundle of similar style of funds, and then I'm looking for how you compile them to develop the best uncorrelated suite of relationships from Linus's data using an algorithm. And then this iterates. I might have 50 funds I come down to, all with a track record of, say, 50 years, track record of, say, 30 or 20 years. So let's say I've got 20 funds of 20 years, 50 funds of 20 years. I then want to bring it down to a selection of, well, how much am I going to invest in this fund of funds? Let's say I can only invest in 10 of them. What is the best correlated ensemble of those 10 managers over a 20-year time frame? And it goes through an iteration loop, and there's so many different possible permutations of that, but the computer fast tracks that, and ultimately I'm looking for the one with the best MAR ratio as a ensemble of 10 managers. So what that's doing is it's simply using the statistics generated from Linus's feed to then compile it together. I'm actually not looking at things that obviously do need to be looked at once you compile that 10, such as, some of the discretionary decisions you need to talk about with those managers. But for this first cut I'm using an algorithm to generate that first cut. It then selects, well, these are the 10 to consider, and that's when then you go and do your due diligence homework on the 10. But that's how I use it, and
That's helpful.
yeah.
To either of you gentlemen, is there a kind of visible difference between newer managers smaller managers and larger managers in terms of AUM? So are there some good performing funds that are still in their infancy or have smaller AUM, and is there any necessary reason to bias an allocation towards the larger fund?
So my very cynical take on that is, like, if you're doing trend following as an allocator, you get roughly the same performance, but you take on much more operational risk. So it's sort of, unless you have some sort of favorable economics with that smaller manager, it's difficult to motivate that from a risk perspective. Of course, you also have the problem, like some of the bigger managers that they've done. Some of them are doing really good jobs, and some of them have done slightly less well recently. So but I guess there's some kind of comfort hiding with the big ones. But if you're a smaller manager, if you're trading something sort of short term or higher frequency, then there's typically a clear distinctive advantage of being a smaller manager. Of course, you have to be honest with your client there. Sort of, how much is my capacity? Do I have more than 100 million, for instance? And what should you tell your marketing guy when he sort of has found this perfect client that wants to allocate $1 billion to you, but and then you sort of probably realize that you have no more capacity left in that strategy. So I think that's the main difference for trend follower. It's unless you have a manager that sort of trades all kinds of the micro markets where you have sort of 10 lots trading every day, then you're probably not going to have like a noticeable difference between smaller and bigger ones. From that perspective, it might be it's probably other choices are going to determine the differences between strategy A and strategy B. But if you do it sort of in the strategies where you actually have capacity constraints, some of the commodity markets, some of the sort of high frequency strategies, they're going to have natural constraints that doesn't allow you to trade that much. And unfortunately, greed will sort of ultimately, they will push any manager to accept too much assets. And then sort of that manager will slowly sort of, they will have steady performance or like flat performance for a few years, and eventually clients will abandon it. And then you have sort of the cycle where sort of they allocate money to a new manager, and then it goes well for a few years, and then you have sort of they deallocate, and then that's the eternal cycle of funds, and probably managers as well. So you always need to stay on top of your capacity estimates. You need to guard your capacity ferociously. Don't allow your marketing guy to sell out of all of your capacity cheaply. Sell it expensively because it's really valuable.
Well, speaking of cheap and expensive, how are fees performing, or how are fees going? Like, do you track fees? Have fees been coming down over recent years? What are average fees looking like?
I think headline fees has been pretty constant. Most CTAs tend to charge you 2-ish and then 20-ish. You obviously have the sort of the commoditization of the trend following crowd where people are offering ETFs or at basically just management fee, a relatively low management fee even. So as a hedge fund trend following CTA, you obviously need to be better than the cheap alternative. Otherwise, it's difficult to motivate the fees that clients are paying. Unfortunately, if you're a smaller manager, you probably need rich fees just to pay the expense that you have at any point in time. So that's why I never sort of it's twice as difficult being a small manager, because you're probably going to experience fee pressure, a lot of it. You might have to share some equity in it. And that means sort of it's going to be more difficult for you to actually sort of grow into a larger organization that you probably need to get those the $1 billion tickets eventually. But there are clearly people that have done it, so it happens. But it's never easy. So.
Linus, your data is on an after fee basis. Is there ever a time where you're considering to include the fee structure in your database for each of the programs?
The fee structure is in there for most of the program. It might not be in a file that you have accessed, but it's in there. So I keep track of the fees, and I keep track of the change over time.
Okay.
So that's I'll show you that to you later. So
I'd like to see that. And look, just another question. In the future, are you planning to expand your database to include some of these ETFs, or what are your thoughts on this growth in the ETFs at the moment?
I should probably do like a CTA ETF index at some point, and I think there's a lot of analytics you can actually do on it. They publish their positions in the public domain, so you can go to Jerry Parker's ETF, and you can probably see which positions he have. Not
Yes.
that it's gonna sort of do any good for you, but you can at least see where they're exposed to. If you sort of can expect that they are gonna be tail protective in a certain situation, or if they are gonna be sort of if they'll be getting whips or changing a lot of positions back and forth.
And tell me, does your database, does it scrape data from the program managers, like automatically generated, or how much of it is input by the managers themselves on a monthly basis versus your if you're scraping? How are you doing that?
So in the beginning, it was sort of a big data gathering exercise, and most of it was sort of scraped from sort of, you have a public fund, a usage fund, or a 40 Act fund. I'm not quite sure what they call in Australia, but you might have some sort of public hedge fund structure there as well. That's sort of more oriented towards retail investors.
Yes.
Some of them obviously have higher fees, and sort of they have worse performance than the main program, or the program that the manager actually would like to showcase. But it's still a decision that if you launch a high fee share class towards retail investors, that's still part of the investment experience that the people that actually trusted you with their money are experiencing. So it's not. It's definitely part of your investment track record. So I scraped a lot of those public disclosed funds. Then some managers have their performance data on their websites. Not all of them. It depends a little bit on which jurisdiction you're working in, to which clients you're targeting. So I have a number of. It's written in R, the computer language. So I have a number of sort of scrapers that goes out and fetches data. But then of course I also have managers that sort of report directly to me. And that's obviously for the managers that don't have their performance in the public domain. That's sort of the primary source of them.
Gotcha. And I notice that you do monthly reporting, but also you're doing a lot of daily reporting. So can you talk about those two different types, and are there different frequencies of reporting outside of the daily and monthly?
So for the daily funds, I that's typically sort of scraped. That means sort of it's an automated process. It's not all of the daily returns may be 100% correct, because there might be sort of some corporate action like a dividend that's missing from a term, and that might take like a few extra days to record that properly. But there are clearly a bunch of CTAs that have daily performance. For the indices that I have on the hedge fund side, they are mostly sort of consisting of US 40 Act funds. I take sort of look at the list of the existing ones out there that are available in fund format, put them together in an index, and I think I actually have the fastest daily CTA index in the market.
I like that.
My sort of small bragging right. So you can actually track sort of your own strategy's performance against that benchmark, like with essentially no lag.
Discretionary traders, Linus, like how have they been tracking, and have you been doing any research on those guys independently, looking at them separate to the quant world?
Yes. So discretionary traders, it's always sort of I think the main beauty of it is they are much more diversified. In the systematic world, you're going to have like some kind of commonality. You're going to have there's a limited set of factors that actually works. Especially if you're longer term. If you're shorter term, there will be more diversification. The discretionary managers tend to be more diverse. They also tend to be better storytellers. I think that's one of the you're always going to get like a sexier story from a global macro manager than a guy that has, okay, here's my system, I built it 5 years ago, and it's just sort of output the trades and I do the trade. It's not a marketable story at all times.
Yeah.
But with the discretionary trader, he's going to tell you sort of how he sort of met with the Federal Reserve, and they gave him some sort of insider information or sort of hints towards which way the markets were going and what they might be doing. So they tend to be much better storytellers. But we wrote an article on discretionary commodity traders some time ago. And that's the sub-segment within CTAs that actually have delivered the most risk-efficient Sharpe Ratio based return. So they are over a period of like 3 or 4 years, they've done the same as sort of trend following CTAs, but without sort of any significant drawdowns.
Surprises me that you say they're more diverse. I would have thought that a discretionary trader would have to be more concentrated on what they could look at, whereas a systematic trader could be absorbing a lot more information.
Yeah, let me clarify that. They're when you compare them against each other, they're more diverse. But you're right. They're human beings, and I think I think there is some magic number of 5 things you can sort of think about at the same time. Some people think about 3 things at the same time, and then it gets blurry. Some people are able to like think about 7 items at one point, or 7 themes at one point, and those are probably the exceptions. And that's probably why McKinsey sort of they tell you to have like 3 bullet points, because people can't keep more in their head at any point. So the discretionary traders they need to know their markets, but they are probably in fewer trades at one point of time. They might have 2 or 3 trades that they're working. It's very uncommon to see a discretionary manager that have sort of 50 or 100 positions.
So the database, how do people get onto it, and is it quite pricey? Can a retail trader start to have a look at this? How would it work?
So there is quite a bit of sort of free data on the site, so you can go in there and you sort of get like quick ranking list to see which managers are actually having decent performance. That might sort of warrant a closer look to it. But obviously, if you want to do something more in depth, if you want to sort of properly analyze a track record, either you just sort of lift the phone and call the manager or text the manager. Can you please send me your information, and let's take a closer look at it. So that's probably the easiest way if you're sort of a retail or sort of non-professional investor. For the guys that are professional investors, there's an option to do what Rich is doing, like you download the raw data, you input that into your system, you run your analytics on it. That probably requires that you have some kind of quantitative resources, or at least a risk manager that can load the data into your system in some kind of decent way. That is it's sort of the IKEA solution, and it's probably priced according to that metric as well. So I charge $2,000 per year, which is cheap compared to a lot of the other databases.
I can vouch for that, Linus. I've had a look at some of the others, and yes, my mind boggles.
Yeah, no, and I think that's also why I sort of kept it. The structure of the data relatively simple. It's a flat file. You move it into your system, and then you do whatever you want to do with it. I don't try to lead you there, sort of in terms of what kind of analytics you should compute. I do that for some clients. I run some sort of more advanced analytics, sort of easier to digest format. So
while we're on that, Linus, just quickly. So are there tools, say a new user who isn't very familiar with manipulating data themselves, you're mentioning that you have some tools in the database that they can use. Can you just explain some of those tools you've got?
So they're a little bit hidden, and sometimes you just need to reach out to me in order to find out what's on the inside. There's a toolkit on the website that allows you sort of plot and quickly compare two managers against each other. So I think you can compare up to 6 traders against each other.
Okay.
That sort of it's a very limited set of analytics, but it's a very quick way of like, yes, okay, I want to see what the track record looks like. Is a drawdown too much, or is the volatility too high? Can I actually stomach this? So that's available on the website. And then I also have a work with a number of partners that have way better analytic software than what I ever sort of have the intention of building on my side.
Could you explain some of them, for example?
So let's see here. I have 5 or 6 different analytical software that I provide data to. They're all listed on the website. Some of them are targeted towards sort of the institutional client, where you probably have to pay. What you would pay like a junior analyst at sort of in the US, so probably around it's going to be up there in the hundreds of Ks. But then you get the complete solution that actually helps you with your investment process. There are simpler strategies that allows you just to screen managers, ranging from sort of relatively mundane to sort of the highly complex one. The probably the most complex one that's still sort of targeting, that has a modest price point, is Alphabot. I know that it contains a lot of analytics, and I think that was very helpful when Rich was trying to bone out the peculiarities of the Serenity Ratio, because he was also calculating it in a third way. So the 3 of us had 3 different ways of calculating the Serenity Ratio, and all of them were kind of correct based on the paper that was written, because it sort of left things to your imagination. And that's and then there's a toolkit that's more geared towards retail, sort of quote unquote retail investors. It's being run in Canada. It's called Sigma Sandbox. That's actually a pretty neat tool, and you get sort of portfolio construction tools. You get a lot of ETFs. You get market data bundled with that. So it's a nice and user friendly toolkit. And I probably forget sort of too many of the other advanced features of the other partners, but and then I'm working with a firm called QDeck that's building a more interactive solution that will hopefully be available soon on the website. That's a curse of developing IT. It always takes 2 or 3 times as long time as you expected initially.
Okay.
So you're the master. You're the master of the data, and then all of these applications are linking into you to sort of expand the analysis side of things.
Yeah, I mean, if I would like to sort of overemphasize my own contribution, of course, you can probably get other databases inside those analytical toolkits as well, because most of the other databases that I'm competing with they can sort of export the same kind of data feeds that I'm exporting. So
you don't have any plans yourself to build up more database tools inside? You'll let third parties do that kind of thing?
I think it's probably been the most cost efficient solution. It's about finding the right people that can develop the right toolkit for you. I had a quant analyst that built like a beautiful solution in one of the R toolkits. But it's sort of, when you compare that to a commercial solution, it's sort of obviously the commercial solutions are much better,
much sexier.
Yeah, exactly. They actually had a graphic designer that worked for them. So
yeah. Rich, do you have anything else to?
I've got one question. It's a bit of a pivot, but it's going back to Linus. You were talking about when you got your short-term trend following fund up and running, and then you went into the French CTA. This is the discussion between the business of allocation, or the business of investing, and the performance of investing. So a good example, Simon, just in relation to what I'm talking about, is we were talking earlier about the size of the fund and whether that has any relationship with its overall performance. But in our trend following world, we've got a particular long-term fund manager with a massive track record, the Paul Mulvaney's of this world, who have got a very small AUM relative to the others, but he's got a very impressive track record, very highly volatile. And what I've found is in delivering these absolute returns, some of these fund managers have a very volatile track record. And whenever I'm looking at the allocations towards these style of volatile funds, they're always fairly low. So there definitely is investor appetite for smoother returns and far less appetite for volatile returns, even though the intent might be to achieve these absolute returns in the long term. And see, I find this also, and I'll be interested to know Linus's thoughts, because he was saying how difficult it was for him to raise AUM with his short-term fund that he had operating back in 2012. And how do we overcome this problem of investors seem to be attracted to size and brand as opposed to performance? How do we overcome that?
I think it's inherent in the sort of being when you allocate other people's money, you probably will always have that bias. You will gravitate towards the bigger managers, the manager with some kind of public perception of that sort of being a great hedge fund manager. That's I mean, of course that list changes over time, but at any point in time you're going to look at sort of who are the biggest managers in this particular sector, who is the biggest trend following CTAs right now, and they are probably going to be the first go-to for any allocator, which makes it sort of problematic if you're trying to start out as a new manager, because you need to get your even if you have a much better strategy, you need to have your business strategy up and going from day one, which is
so as an allocator. Is an allocator facing the same problems as a trend follower, like someone trying to start up in the trend following world, in that the allocator is also allocating towards the brand as opposed to the performance, and that begs the question: in the competitive space that's allocation, surely there's an edge from those allocators who are using, these comprehensive analytical methods to do their allocation, as opposed to simply being attracted to brand. Do you see it that way? Is there that opportunity?
Absolutely. I've seen especially in the commodity space, I've seen a large number of fund of funds or sort of allocators gravitates to those like very, very specialized niche managers. You have a manager that sort of just spent his time trading cattle futures, for instance, which is two markets. There might be sort of a small option market in it as well. But that really requires some sort of really sort of dedication to those markets. Likewise, if you're looking for the sort of the smaller high frequency managers, some of them will they will sort of work really, really well in a portfolio. But there it's sort of obviously you have the problem, you can't sort of grow them to infinity and beyond. They're always going to be sort of they're always going to be small managers. As an allocator, you probably also have to accept that those managers are actually going to come with higher operational risk. There's going to be more mistakes. You might have some sort of fund issues at some point, and that's always a trade-off. The more transparency you need to give to your end client, the more likely you are to end up with the bigger names. The less transparency you have to give to your sort of average client, the more liberal you can be in sort of who actually you're allocating to.
I was thinking our audience on the algorithmic advantage, like it's a growing wider audience now, and it's not just focusing on trading or investing. It's also allocation is such a big part of the game for those investors who want to allocate towards different fund managers. And I'm hoping, Linus, that we can get you on the episode in future episodes to maybe go into the the tic-tacs of how you go about the process of allocation. Maybe we can do it in a way that informs and educates viewers on a very robust method of allocating, those sort of things. Hopefully you'd be interested in that if we can get you on in future shows.
Yeah, absolutely. Then I think we should probably invite Art Holly as well. He has done a lot of work on that side. So and he's definitely got sort of more. He's a better storyteller than what I am. And he's definitely
we'll have a few good laughs as well when we all get together.
Indeed. Well, I was just going to say, Linus, it's about midnight your time, so we appreciate you staying up late for us.
It's actually 2 a.m. So.
Oh my God.
Oh no.
So, but it's been a pleasure.
Excellent. Yeah. So I don't want to keep you any longer than we need to, and we've covered a lot of ground, which is good. It's really interesting to me the level of diversity that's required to, I guess, to reduce risk. The diversification. Free lunch can just get played out in every conversation, in every angle, and everything that we do. It's the one big win that we can get, whether we're just trading, allocating, developing more systems ourselves. But interesting that, the specialists in their field as well continue to outperform. The database sounds fascinating. I think it's really helpful for not only for the professionals, but for the newer guys to be able to benchmark themselves and understand exactly what is a realistic expectation for their Sharpe or their MAR or their annual returns or the lumpiness of their returns. So we really wish you all the best with it, and looking forward to continue to do those monthly reviews, as it were, and see how different people are going as Rich does now. So just give us your website and your Twitter handle, or tell us how people could get in contact with you and learn more.
Right. The website is it's NilssonHedge.com. It's 2 S's. That's sort of unique with the Scandinavians or Swedes. We have 2 S's instead of 1 S. In our son names. My Twitter handle is the same, NilssonHedge. I had a smaller one where I was pushing my daily updates. Was called Hedge Index or Index Hedge. Unfortunately, that account sort of I stopped updating when Elon Musk sort of changed his API access. I was a little bit sad. So.
I wish you hadn't, Linus. I was looking at that regularly. That was a great little indicator on a daily basis.
Yeah, no, it was like I was pushing out like 5 or 6 tweets every day and say, okay, here's what you did yesterday. If you did better than this, you should be happy. But that was tremendously useful when sort of the CTAs had this kind of micro crash or from in March, where sort of there was sort of really big outliers. You could follow that on sort of on a almost like on a daily basis.
Maybe you could push that. Linus, through. I mean, we've done some development work with Telegram, the messenger service, and it's quite easy to use their bots and services. So you could develop, say, a Telegram following and push. I'd love to follow, daily updates like that.
Yeah, I mean, I think I have another quant, and she was like looking into Telegram. We might try to do something there. I don't know how it is to build like the following on Telegram. If that's much more difficult. Twitter is this kind of random audience. Telegram, it's you always think that's going to be like a bunch of crypto guys and some Russian bots that sits there and pumps out messages.
You'd have to advertise it on Twitter and send them over or something. But all right,
and then you're going to get banned on Twitter. So.
Yeah. And so that's the best way for people to get in contact you. Go to the website, nilssonhedge.com.
Yep, that sounds about
Just
right.
Go there. Okay.
Yeah. And I guess you can put some comments at the end of the episode or something that might work as well.
We'll add the links. All right, Linus. Well, thank you very much. We really appreciate it, and it's great to, as I said, deep dive into what everyone else is doing. So you're doing a fantastic work for the industry. We really appreciate it, and we're super keen to stay in touch. So thanks once again.
Absolutely. Thanks, Simon. Thanks, Rich.
Thanks, Linus.
Pleasure being here.
Thanks very much.
We should remind you that the conversations on this show are informal and for entertainment purposes only. Certainly any general advice you may hear is obviously not specific to your needs, goals or objectives, so nothing discussed on the show should be considered as investment advice. If you want that, you'll need to actually do your own research and speak with your financial advisor. Remember, trading can be extremely risky and past performance is not necessarily indicative of future returns. If you enjoyed the show, please subscribe or leave us a review, and if you have any questions or feedback, we'd love to hear from you. Bye for now.